In today's video, I will share with you the best supply and demand zone strategy for entering high probability trades you haven't seen before. This strategy is so powerful that it can literally be applied on any market, including crypto, stocks, and Forex. I will also backtest this 100 times with an initial account size set at $1,000 with a 1 to 1.5 risk to reward ratio, just to prove how effective this strategy can be in different market conditions. So make sure to stay focused and learn this strategy technique that you will not find anywhere else. Like, subscribe, and turn on those notifications so you don't miss out. Now, without further ado, let's get into it. Okay, for my backtesting, I'm going to be using the price of Apple on a 5-minute time frame. If you prefer trading on higher time frames, don't worry, because you can use this strategy on the 15-minute, the 1 hour, and even on the daily chart. Okay, before we get into this strategy, we need to first understand how the law of supply and demand affects the market. The law of supply and demand is a theory that seeks to explain the relationship between the availability and desire for a product such as a security and its price. Typically, low availability and high demand will boost the price of an item, and high availability and low demand will reduce its price. And by knowing the law of supply and demand, we can predict with high accuracy where the price action is going to go in the near future. So to put the theory into practice, we need to first understand how to properly identify the supply and demand zones. Now, you may be asking, what exactly are supply and demand zones? Supply and demand zones are a popular analysis technique used in day trading. The zones are the periods of sideways price action that comes before explosive price movements and are typically marked out using a rectangle tool in a stocks, Forex, or CFD's trading platform. As we can see, when the price action reaches the supply zone, it always gets rejected. Exactly opposite works when the price action is reaching the demand zone. In this video, we're not going to be focusing much on the theory, otherwise the video will be way too long. So let's jump into the trading rules so that we know exactly when to enter the trade, where to place our stop losses, and our take profit targets. Okay, so here are the rules for entering a long trade. First, we need to have a strong bullish momentum formed in the market. This momentum is usually happening after a bearish trend. Second, we need to identify the demand zone. For that, we need to find a bullish candlestick that marks the origin of a strong uptrend. In this example, the candlestick that marks the origin is going to be this one right here. Notice that once this candlestick was formed, the price action started moving in an upwards direction. Next step will be to draw a rectangle from the top to the bottom of this candlestick. Okay, so we've just identified our demand zone. The next step will be to wait for this price action to pull back into this zone. And once we have this pullback, a bullish candlestick has to be formed, and it needs to be closed above the demand zone and the body of the most recent bearish candlestick. Okay, so this is going to be our trigger candlestick, and we're going to be placing a buy order on the close of our trigger candlestick. Our stop loss will be set slightly below our demand zone, and we're going to be targeting 1.5 times the risk. Okay, here is another example. So here we see the price action was moving in a downwards trend, then it gapped and a strong bullish candlestick was formed in the market. And once this candlestick was formed, the market participants pushed the price action higher. So this is a strong indication that the price action reached the demand zone and it got rejected. So the candlestick that marks the origin of a strong uptrend is going to be this one. The demand zone has been identified, the pullback has also occurred, and now we're simply waiting for a bullish candlestick that should close above our demand zone and the body of the previous bearish candlestick. Okay, we just got our trigger candlestick, so we'll be placing our long entry on the close of our trigger, bringing our stop loss there down just below our demand zone, and once again targeting 1.5 times the risk. Notice how many more times this price action pulled back into our demand zone and got rejected. A new demand zone can also be spotted in an uptrend after a consolidation phase, just like in this example right here. We see that the price action was ranging and then a strong bullish move appeared in the market, and this strong bullish candlestick is the origin of the new demand zone. The market participants kept moving the price action higher, and then a pullback occurred. A bullish candlestick was closed above the demand zone and the body of the previous bearish candlestick. So we're going to follow the rules and execute a long trade. By the way, if the price action closes below the demand zone, you do not take any long positions. All you do is simply wait for a new signal. Alright, now let's understand the short positions. First, the market needs to form a strong bearish candlestick that will push the price action down. This candle marks the origin of the downtrend, and this is going to be the candlestick that we're going to be using to draw our supply zone. Okay, the supply zone has been successfully identified. Now we need to have a pullback into this zone. Then we need to have a bearish candlestick that would close below this zone and the body of the most recent bullish candlestick. Okay, we can see that such candlestick has been formed. So we're going to go ahead and place a sell order at the close of this trigger candlestick. Our stop loss will be set slightly above our supply zone. And once again, we will be targeting 1.5 times the risk. Here is another short example. We see that this is the origin candlestick for our bearish downtrend. We then drew up our supply zone. We got a pullback into it. Our bearish candlestick was formed here that closed below our supply as well as our previous bullish candlestick. So we'd be opening our short position on the close of this, bringing our stop loss up just above our supply, and once again targeting 1.5 times the risk. So we see that this strategy works just like magic. Now let's do our backtesting to find out it's true. Alright, the backtesting is now complete, and here are the results. Okay, so after 100 trades, the results are incredible. The win rate for this strategy is 73%, and we gained over 360% profit on our account. The profit factor is 3.72, and we had 14 consecutive wins against 4 consecutive losses. Also, the maximum drawdown for the strategy does not exceed 10%, which is absolutely amazing. So yeah, traders, definitely give this strategy a try, backtest it and forward test it with paper money and see if it works for you. If you have any questions, please ask them down in the comment section. If you enjoyed, please leave a like, comment, subscribe, and turn on those notifications so you don't miss out. I love you all. Peace.